The last example that we look at in Chapter 10 is practical example 4, where we prepare the post-closing trial balance. That is the trial balance that we prepare after closing of every single income and expense account. In other words, those accounts have now zero balances, and because they have zero balances, they will not be included in the post-closing trial balance. The only accounts to be included in the post-closing trial balance are your asset, liability, and equity accounts. What you also need to remember is that the drawings account has also been closed off against the capital account. So that account will also not appear in the post-closing trial balance. In order then to see which accounts are going to be included in the post-closing trial balance, you have a look at your post-adjustment trial balance. The capital account will be included. If we then go and have a look at what is the capital's balance for the post-closing trial balance, we start off with the balance of 41,800 from the post-adjustment trial balance. Remember, we transferred the profit for the year to the capital account, so we increased the owner's investment in the business. But during the year, he had also taken 6,000 Rand out of the business, so that reduces his investment in the business. So deduct the 6,000 Rand. The new balance for the capital account is therefore 38,450. As I said, drawings has been closed off to capital. That is not included in the post-closing trial balance. Next accounts that we look at then, land and buildings, furniture, accumulated depreciation, vehicles, and accumulated depreciation on that, and also inventory. The land and buildings and the furniture at cost and the vehicles at cost, those amounts are transferred as is from the post-adjustment trial balance. And if we just go and have a look at the accumulated depreciation accounts for furniture and for vehicles, those accounts are also still remaining. They are not closed off. There were no closing entries that affected those two accounts. So those two balances are also transferred as is. And as I mentioned, inventory is also transferred straight from the post-adjustment trial balance. It is not closed off. If we go and have a look at the next accounts in the post-closing trial balance, so we look at cost of sales, purchases, returns, sales returns, freight and purchases, rent income, salaries and wages, commission received, water and electricity, depreciation, credit losses. These are all income and expense accounts. They have been closed off, so their balances are zero. They are not in the post-closing trial balance. The next accounts that we then look at is bank, debtors, allowance for credit losses, creditors, rent received in advance, salaries and wages accrued, water and electricity paid in advance, commission receivable. All those amounts are transferred as is. And there they all are. 6, 4, 2, 8, 50 and 40 in the debit column. In the credit column, 140, 19, 300 and 500. And that is your post-closing trial balance. Very simple. The only calculation that you really need to do is for the capital account. Take the balance according to the post-adjustment trial balance. Remember to add the profit for the year from the profit or loss account. Deduct the drawings because you're closing drawings off to the capital account. And that then determines the new balance for the capital account. But all the other accounts in the post-closing trial balance are transferred as is from the post-adjustment trial balance. And remember, no income and no expense accounts in the post-closing trial balance, only asset, liability, and equity accounts. And the only equity account is the capital account. And you add up the debit and the credit columns, and you will see that the trial balance balances.